This week's episode will deep dive into 5 high-flying #1 daily percentage gainers with market caps between large to nano range, including a stock with 2 crowns and couple IPOs for the trading week of March 31st to April 4th, 2025. American Rebel Holdings Incorporated has been carving out its niche in the personal security and lifestyle space by blending function with a distinct sense of Americana style. At its core, American Rebel is about self-reliance, safety, and identity, offering everything from heavy-duty gun safes to concealed carry jackets that look as good as they are functional. But more recently, the company has been gaining attention beyond just its product line, with a few notable business developments that could shift the narrative for investors who've been watching from the sidelines. The company's bread and butter remains its line of branded gun safes and concealment apparel. The safe collection, ranging from the AR-12 to the heavy-hitting AR-50, continues to cater to a very specific market, those looking for fire-rated, secure storage for firearms, valuables, and sentimental items. These aren't just practical purchases, they're emotional ones. American Rebel has branded itself not only as a security product company, but also as a keeper of heritage, leaning into patriotic branding and the Second Amendment lifestyle, which helps build loyalty among a customer base that values both functionality and personal freedom. Where things have started to pick up lately, though, is in the company's more aggressive push toward growth and market expansion. One of the most significant recent moves was American Rebel's acquisition of Champion Safe Company, which officially closed not long ago. Champion has long been known as a premium player in the gun safe industry, and this acquisition marks a serious leap forward for American Rebel, not just in terms of product breadth, but also manufacturing capability, distribution channels, and brand equity. Champion's operations are larger, more established, and give American Rebel an immediate boost in both revenue and production scale. And this acquisition isn't just a bolt-on. It signals that American Rebel is looking to go from being a niche player to a broader force in the security product space. By bringing Champion under its wing, it gains a higher-end clientele, more premium price points, and a stronger manufacturing backbone. It also gives American Rebel more leverage in retail distribution, which could be a meaningful tailwind for expanding its footprint beyond just direct-to-consumer sales. But it's not all smooth sailing. The company did recently announce a direct offering of over $2 million in gross proceeds, something that initially caused some investor hesitancy. Dilution is always a touchy topic, especially for microcaps. But in the context of recent moves, this capital raise makes a bit more sense. They're fueling growth, supporting the integration of Champion, and likely beefing up their inventory and marketing spend as they look to scale. It's a short-term hit for what could be longer-term gain if execution is strong. It's also worth noting that American Rebel's strategy goes beyond just being a product company. They're building a lifestyle brand. This is especially true on the apparel side. Concealed carry clothing isn't a massive market, but it's a passionate one, and American Rebel has managed to create apparel that's both functional and stylish. The Cartwright coats, Freedom 2.0 jackets, and the broader apparel line aren't just merch. They're built to serve a very specific purpose while aligning with a very particular identity. That kind of brand clarity is rare in small-cap consumer goods companies, and it gives them a runway for expanding into adjacent categories down the line. Think EDC gear, accessories, or even outdoor survival equipment. As of late, the stock has seen some renewed trading volume, likely tied to the post-acquisition buzz and capital raise, but it's still sitting at relatively low levels. This gives investors a classic microcap profile, high risk, but potentially high reward. Execution will be everything from here. How well the company integrates Champion, leverages its increased scale, and continues to build brand loyalty in a competitive market will dictate whether American Rebel can break out of the microcap wilderness and into something more formidable. So where does that leave things for investors? American Rebel is still a speculative play, but it's one with some momentum. There's now a clearer roadmap to scale, a broadened product base, and a niche but loyal customer segment. If management can translate this into sustainable growth and find a way to maintain margins amid expansion, it could be one of those sleeper plays in the small-cap world that starts to punch above its weight. But it'll take disciplined execution, tight financial management, and a continued ability to speak to its core audience without diluting the brand. Investors looking for upside need to watch the next couple of quarters closely, particularly around champion integration progress and any hints of further expansion or retail deals. More in-depth review of American Rebel Holdings Incorporated to come after next. iCoreConnect Inc. is a cloud-based software and technology company that's been flying under the radar for a while now, but it's definitely starting to catch more attention, though maybe not all for the reasons they'd like right now. The company's whole mission is centered around helping healthcare and dental providers improve their daily workflows, saving time, cutting down administrative pain points, and boosting practice profitability. They've built out a whole suite of SaaS tools, over 16 different products at this point, ranging from e-prescriptions and HIPAA-secure email to revenue cycle management and real-time insurance verification. Basically, they're trying to become a kind of one-stop shop for managing the messy, repetitive back-end work that clogs up clinics and dental offices all over the country. Their pitch is simple. Doctors and dentists didn't go to school to fill out insurance forms or track compliance policies. They want to treat patients. But the reality in healthcare today is that practices are drowning in paperwork, siloed systems, and clunky processes that haven't evolved much in years. That's the gap iCoreConnect is trying to fill. By offering cloud-based, fully integrated software, the idea is that they can streamline everything behind the scenes, letting providers focus more on care and less on bureaucracy. And here's where things start getting more strategic. iCoreConnect hasn't just been building tools and hoping people show up. They've been incredibly intentional about distribution. Instead of trying to go door-to-door and sell to individual practices, they went upstream. They formed partnerships with state and regional healthcare associations. These associations are trusted by their members, doctors, dentists, surgeons, who rely on them for recommendations, regulatory updates, and industry standards. By becoming a vetted, endorsed vendor through those organizations, iCoreConnect gets a kind of built-in trust and direct access to thousands of potential customers. That's a smart move, and to date, they've signed over 100 of those agreements nationwide. It's slow and steady, but it's real infrastructure. So with all that going on, why the sudden spike in noise around the company? Well, here's the kicker. Just recently, iCoreConnect announced a 1-for-200 reverse stock split. And yeah, that number is massive. Most reverse splits you see are in the 1-for-10 or 1-for-20 range, maybe 1-for-50 at the extreme. But 1-for-200? That tells you this wasn't just a technical adjustment, it was a scramble to stay compliant. When company stock price drops below $1 for an extended period, they risk being delisted from NASDAQ. That comes with all kinds of consequences: less visibility, less investor confidence, fewer financing options. It's a slippery slope. So iCoreConnect did what many struggling microcaps do. They consolidated their shares to push the price back over the $1 mark and buy themselves more time. But make no mistake, this is a survival mode kind of move. Reverse splits don't create value. They just reshuffle the optics. But let's pause here because this is where things get a little more nuanced. Yes, a reverse split of this size usually signals distress. But in iCoreConnect's case, it's happening alongside some real business developments, not just as a last-ditch Hail Mary. While their stock price has been languishing, the company has still been making moves, expanding into the medical side of the business, exploring new products, and leaning further into their state association distribution strategy. And that's key, because while dental has been their stronghold, the medical side of the market is huge and still very underdigitized. The healthcare industry at large is in this weird, slow-motion digital transformation. COVID pushed a lot of practices to adopt new tools and cloud-based systems, but we're still nowhere near full adoption. Many clinics are still using old desktop-based software, or worse, manual processes. So the opportunity is massive if iCoreConnect can position itself as a modern, affordable, easy-to-implement solution. That's why their expansion into medical workflows is worth watching. If they can take what they've built in dental and scale it to primary care offices, specialist clinics, outpatient centers, and beyond, that opens the door to a much bigger addressable market. But that's still a big if. Because here's the thing, growth costs money. And iCoreConnect has been burning through cash to get where they are. They've had to invest in product development, sales infrastructure, support teams, and of course, compliance. Healthcare is a regulated beast, and building secure, HIPAA-compliant tech isn't cheap. They're not profitable yet, and there's always the looming question. How much runway do they have left before they need to raise more capital? And that brings us back to the reverse split. One reason companies need to stay listed on NASDAQ is access to capital. Institutions, funds, and certain investors won't touch OTC or pink sheet stocks. If iCoreConnect had been delisted, their ability to raise future funding through equity or convertible notes or partnerships would have been severely limited. So in a weird way, the reverse split isn't just a technicality, it's about keeping future options open. It gives them the room to breathe, to survive long enough to prove the business can scale. But now the pressure's really on. The next couple of quarters are going to be absolutely critical. Investors are going to want to see concrete signs of progress, SaaS revenue growth, higher average spend per customer, reduced churn, maybe even some enterprise or institutional wins. The association deals are great, but now the question is, are those relationships translating into meaningful recurring revenue? Are providers actually adopting multiple modules of the platform? Are they sticking around? Are referrals increasing organically? We're also watching for traction in the medical vertical. If they can start showing early momentum, say a new association partnership in the medical space, or even just a strong pilot program with a multi-location provider, that could flip the narrative entirely. It would show that their model is extensible beyond dental, that they can address broader use cases and generate more revenue per customer. There's also an M&A angle to consider. Companies like iCoreConnect, with niche vertical software and deep integration into a specific professional ecosystem, often become acquisition targets if they reach scale. Larger healthcare tech firms are always on the lookout for bolt-on acquisitions that give them more reach or deepen their footprint in underserved markets. If iCoreConnect can prove their model works and that their customer base is sticky, it's not hard to imagine a scenario where a larger SaaS or health IT player scoops them up for their association's pipeline and recurring revenue base. But again, it all hinges on execution. We've seen plenty of SaaS players with great ideas flame out because they couldn't manage costs, retain customers, or scale past their early adopter base. iCoreConnect has a compelling story, but stories don't pay the bills. What matters now is whether they can turn all this infrastructure, the products, the partnerships, the sales strategy, into real, sustainable revenue. If you're an investor watching from the sidelines, the play here isn't to jump in blindly because the stock is cheap after the reverse split. The smart move is to wait and watch. The post-split trading action will be volatile. But look beyond that. Watch the earnings reports. Look for signs of operational discipline. Are they tightening up costs? Are gross margins improving? Is the sales cycle shortening thanks to association referrals? Are they diversifying outside of dental in a meaningful way? Because if the answers to those questions start to turn yes, then you could be looking at a true turnaround story. One that's not driven by hype, but by good old-fashioned execution. And in a market full of hype and hot air, that kind of story is worth paying attention to. American Rebel Holdings Incorporated has had a particularly eventful stretch this past week, and not just on the business front. Its stock performance has been explosive, catching the attention of speculative traders and microcap investors alike. But to really understand what's going on, we have to unpack both the strategic business maneuvers the company has made recently and how those moves are rippling through the market. Let's start on the business side. American Rebel has been in a transitional phase, evolving from a niche manufacturer of gun safes and concealment clothing into something more diversified and potentially more scalable. Its acquisition of Champion Safe Company last year was a big step in that direction, essentially taking the company from being a brand with patriotic roots and a loyal base to one that now has deeper manufacturing capabilities and a broader retail reach. But while the acquisition created an opportunity for growth, it also meant American Rebel needed to shore up some fundamentals, especially when it came to meeting the requirements to stay listed on the NASDAQ. That's where the reverse stock splits come into play. Over the past 6 months, American Rebel has executed not one, but 2 reverse splits. The first, a 1-4-9 reverse split, happened in October 2024. The most recent one, a much more aggressive 1-4-25 split, was implemented just last week on March 31st, 2025. Now, reverse stock splits often raise eyebrows. They don't change a company's market cap, but they do inflate the share price by reducing the number of shares outstanding. And companies typically do them when they're at risk of being delisted for trading under the minimum $1 threshold. So, in American Rebel's case, this was very much a move to stay compliant with NASDAQ listing rules. But they took it one step further. They structured the reverse split with a round-lot shareholder protection mechanism. What that means is anyone holding at least 100 shares before the split would still have at least 100 shares after, a move clearly designed to protect retail investors from being wiped down to fractional shares or facing liquidity issues. At the same time, the company finally got back on track with its regulatory filings, regaining compliance with NASDAQ's periodic reporting standards. That was another key step in solidifying their public listing, and the timing wasn't coincidental. With these filings back in order and the reverse split in place, the company effectively hit reset, now trading under a much higher per share price, and importantly, with a clean slate on compliance. That brings us to the stock itself. Over the past week, American Rebel's stock has gone absolutely parabolic. After the reverse split went into effect on March 31st, the stock started climbing rapidly. By April 5th, the share price had reached around $19.50, an eye-popping move from where it had been trading just days before. At its peak during the week, the stock surged to an intraday high of over $22, while the trading volume exploded to more than 83 million shares on a single day. To put that in perspective, this kind of volume and price movement is rare in small-cap land unless there's a catalyst. And in this case, it was a perfect storm of technical adjustments, improved compliance, and renewed speculative interest. What's driving this frenzy? Part of it is mechanical. Reverse stock splits often reduce float, which makes it easier for aggressive trading activity to drive sharp price movements. With fewer shares available and a newly clean NASDAQ listing, American Rebel became a prime target for momentum traders and day traders looking to capitalize on low-float volatility. Some of this activity was likely driven by algorithmic trading, possibly triggered by alerts tied to the split and volume spikes. And when a stock starts moving like that in a microcap space, it tends to attract more eyeballs, which just compounds the momentum. But here's the thing. Underneath all the volatility, the fundamentals haven't changed dramatically in a week. Yes, the company has improved its compliance and cleaned up its listing. Yes, the Champion acquisition has potential to be transformative if integrated well. And yes, there's a loyal consumer base that aligns with the brand's lifestyle appeal. But at the same time, this is still a company operating in a very competitive space with a relatively small revenue base. For the 3 months ended last reported, they brought in just over $2.3 million in revenue. Over the 9-month stretch, revenue totaled a little under $10 million. So while there's growth potential, it's still early stage and far from being a cash cow. That makes American Rebel stock at this moment more of a high-risk, high-volatility play than a pure fundamental investment. The current price action reflects short-term trading interest rather than long-term value realization. That could change if the company follows through on integrating Champion effectively, expands distribution, and sustains growth in both safes and concealment apparel. But for now, what investors are seeing is a speculative pop built on a combination of technical cleanup, market mechanics, and social trading dynamics. For anyone watching this stock, the next few weeks will be critical. Will the stock hold its elevated levels or come back down to earth as the buzz fades? Will management seize the moment to communicate a clearer long-term strategy now that compliance is no longer the immediate issue? And will we start to see any early synergies or growth data from a champion side of the business? All in all, American Rebel finds itself at an inflection point. It's cleaned up its NASDAQ status, attracted attention, and gotten a fresh wave of visibility. Whether it can turn that into sustained growth and investor confidence, or whether this is just a short-term pop before fading back into microcap obscurity, will depend entirely on execution from here. Waton Financial Ltd. is an investment holding company that operates through its two main subsidiaries, Waton Securities International Ltd., or WSI, and Waton Technology International Limited, or WTI. At the heart of its business is a combination of traditional financial services like securities brokerage and more modern tech-driven offerings like software licensing and support. The company straddles both the old world of finance and the new wave of fintech infrastructure, which gives it an interesting edge, especially as financial markets continue to digitize globally. The WSI side of the business is really about access. They offer securities brokerage services, making it possible for clients to participate in stock trading, asset management, and investment activity, mostly focused on Hong Kong and other Asian markets. But it's not just about brokering trades anymore. WSI also provides software tools that clients can license, helping them build their own platforms or trading systems. These services come bundled with support and integration capabilities, making WSI not just a service provider, but a kind of infrastructure partner for smaller financial firms or new entrants looking to plug into the markets quickly. Then there's WTI, the technology arm that operates more like a traditional enterprise software business. WTI licenses financial software, trading platforms, risk management tools, client management systems, and provides support to keep them running efficiently. It's the less headline-grabbing side of the business, but arguably the more scalable one. In the long run, this could be the engine that brings in recurring revenue, especially if they can keep expanding their client base. Now, zooming in on what's been happening recently, Waton Financial just dropped a big headline that's caught some attention. They're jumping into the AI sector, and not in a superficial way. They've launched an AI-focused strategy aimed at integrating advanced large language models, LLMs, into the brokerage and financial services world. That's a pretty major shift, and it's not just hype. They're actually looking to roll out a ChatGPT-style tool that acts as a kind of virtual analyst, compliance officer, or trading assistant, depending on the use case. That's a serious pivot that could redefine what kind of company Waton is. Instead of being just another small-cap brokerage firm with software offerings on the side, they're now positioning themselves at the intersection of finance and AI. If this move pans out, they could end up as a tech-first player in an industry that's still trying to figure out how to really leverage generative AI in regulated environments. What makes this particularly interesting is that they're not just slapping AI on top of existing tools, they're building around LLM integration for core functions. Think customer support automation, real-time compliance checks, natural language trade queries, financial data summarization, the kind of tasks that normally require a team of analysts or support staff. By deploying LLMs, they're trying to make those roles more scalable and cost-efficient. For a brokerage business, those operational efficiencies could directly improve margins, especially in the highly competitive Asian markets where fees are under constant pressure. Another recent development worth noting is the company's new strategic cooperation with Guangdong Nanhua Bank's Hong Kong branch. That's a major state-linked institution, and having a relationship like that opens up a whole new channel for credibility, deal flow, and potential client onboarding. Even if the partnership starts small, it's a signal that Waton is moving in more institutional directions, not just retail. With that backing, or at least that validation, it gives them a bit more legitimacy in a space where scale and trust matter. This combination of announcements, AI integration, and a traditional banking partnership really shows the dual nature of Waton's identity. On one hand, they're positioning themselves as an innovation-driven firm willing to bet on where the puck is going. On the other hand, they're still operating in a highly regulated, relationship-based financial ecosystem. That balance is hard to pull off, but if they can do it, it creates a moat. Few fintech players can claim to have both deep tech capabilities and long-standing financial services infrastructure. But of course, there are some big questions hanging over this whole narrative. The biggest one is execution. It's one thing to announce a pivot into AI. It's another to build it, launch it, and have it actually work in the real world, especially in finance, where regulations are strict and users are demanding. Large language models are impressive, but they can also be unpredictable, and accuracy is non-negotiable in finance. If a chatbot gives incorrect trading advice or misclassifies a compliance issue, the consequences are massive. So they're going to have to be incredibly careful about how this tech is rolled out. Another thing to watch is how well they monetize this AI layer. Are they just using it internally to cut costs, or are they planning to license it out to other brokerages? Will they bundle it into existing WTI software offerings or spin it out as a separate product? The go-to-market strategy here is going to matter a lot. If they can prove out a real use case and start landing clients, especially institutional ones, the value proposition suddenly becomes very real. But if this ends up being more of a marketing play than a business model shift, investors will catch on fast. Financially, the company is still relatively small. It's a microcap by most definitions, which means it's going to be volatile, thinly traded, and heavily sentiment-driven. That makes these kinds of pivots even riskier, but also more rewarding if they succeed. The market loves a good turnaround or transformation story, especially when there's a tech angle. If Waton can show real traction on the AI side and back it up with new clients or higher margin revenue, the stock could move fast. But it'll all come down to results, not just press releases. And then there's the bigger macro environment to think about. The Asia-Pacific financial services sector is going through a lot of change right now. Rising rates, regulatory shifts, digital currency pilots, and increasing competition from both traditional players and new fintechs. In this climate, firms that can move fast and adapt to new technology will have an edge. But it's also a time when smaller firms can get squeezed out if they don't scale quickly enough. Waton is right in that sweet spot where they have to choose, play it safe and stay small, or swing big and try to disrupt. It seems like they've chosen the latter. For investors, the opportunity here is asymmetric. There's a lot of downside if things don't work. The AI project fizzles, partnerships don't convert into revenue, or the tech stack can't scale. But the upside is there too. If they execute, even modest success in the AI plus finance integration space could give them a whole new identity in the market. And given how early this move is, investors who get in before the pivot proves itself could end up ahead of the curve. The next 6 to 12 months are going to be incredibly telling. If we see product demos, client adoption, revenue upticks tied to new AI-driven services, and continued expansion of institutional relationships, it would go a long way toward validating this new direction. But without those signals, this could end up as just another small cap trying to chase the AI hype cycle. So in short, Waton Financial Ltd is at a major inflection point. It's a company with legacy infrastructure, newly forming institutional ties, and a bold move toward cutting-edge AI. The bones are there. The vision is ambitious. And now it's time to watch closely and see if they can deliver. Because if they do, this isn't just a brokerage firm anymore. It could be the start of a new kind of financial technology platform, lean, smart, and AI native. Newsmax Incorporated is a holding company that owns Newsmax Media Incorporated, and if you've been tracking the company lately, you've probably noticed that it's been generating more than just media coverage. It's been stirring up serious interest in the business and investing world, too. Most people recognize the name for its television presence, especially as a cable news outlet that appeals to a more conservative demographic, but the business itself is far more layered than a typical broadcaster. It's evolved into a multi-platform content publisher with a sprawling presence that spans digital media, subscriptions, e-commerce, and increasingly, some very strategic positioning in the broadcast landscape. At its core, Newsmax has two main revenue-generating engines, the broadcast segment and the digital segment. The broadcast side is probably the most visible. This is where they produce and license content, news, business commentary, lifestyle programming, and distribute it across MVPDs, which includes your usual suspects, cable TV, satellite providers, and telco platforms. But what's important to understand from a business perspective is that Newsmax isn't just a channel filling airtime. They're building a brand that is deeply embedded in a loyal viewership. That's critical in an age when cord cutting continues to threaten the traditional cable model. Despite the trend of audiences leaving cable, Newsmax has actually been growing its footprint in the MVPD space. In the last year, they've locked in new distribution deals and, more notably, regained their spot on DirecTV after a very public carriage dispute. That battle over fees and access may have made headlines for political reasons, but the business takeaway is that Newsmax came out with more leverage than before. That win not only preserved their access to a significant chunk of their audience, but it also signaled to the rest of the industry that Newsmax isn't just a fringe player anymore. They're a network with real negotiating power, and increasingly, a must-have for certain demographics. And that translates directly into ad dollars. With the DirecTV carriage issue behind them, Newsmax can now go back to advertisers with a strengthened case, a loyal and growing viewer base, proven demand, and clear influence. That kind of leverage matters immensely when you're in the game of selling linear ad space in a fragmented media world. But where things get really interesting, and where long-term investors should be paying close attention, is on the digital side of the business. This isn't just a secondary income stream, it's a full-on engine of recurring revenue and scalable growth potential. The digital segment includes everything from online advertising, like display and email ads, to subscription-based newsletters and e-commerce. We're talking about health and finance content, niche political commentary, and even nutraceutical sales. And that last piece might sound like a strange addition at first glance, but it's actually a smart move when you think about it from a monetization standpoint. Newsmax has a very targeted, loyal audience. They're engaged, they respond to calls to action, and they trust the brand. That's the holy grail of direct-to-consumer marketing. So when Newsmax offers supplements, books, or premium newsletters to that audience, they're not casting a wide net. They're making highly efficient, data-backed offers to people already primed to buy. It's a business model you see working for other niche publishers, but Newsmax may have one of the more robust implementations of it in the current media landscape. They've also leaned hard into email advertising and digital lead generation. Email may sound like an old-school channel, but when used correctly, it's one of the most cost-effective, high-conversion platforms in the playbook. Newsmax is leveraging this channel to not only sell products and subscriptions, but also to gather data and build up its first-party audience segments. That's crucial, especially with the broader shift away from third-party cookies and the increasing importance of owned audience data. This means that as advertisers get more picky about where they spend, Newsmax can offer targeted buys with deeper insights, and that's something traditional broadcasters can't always do. Now, let's talk about scale and growth. The media industry is tough right now. Revenue from traditional advertising is under pressure across the board. Digital CPMs are down in many segments, and tech platforms like Google and Meta are still dominating a huge share of ad budgets. So for a company like Newsmax to keep growing, it's going to have to keep diversifying its income streams and doubling down on what it already does well, namely building loyalty, monetizing directly, and expanding its multi-channel strategy. One of the more underappreciated aspects of the business is how they've turned their print and membership programs into a reliable revenue stream. Most digital media companies have abandoned print altogether. Newsmax didn't. They've kept Newsmax magazine running, along with 4 distinct membership programs tailored to different interest groups. And here's the kicker. These aren't just casual readers. These are paying subscribers who are actively investing in access to curated, niche content. That's recurring revenue, and it's stickier than you'd expect. In a media environment where one-time traffic spikes from social media aren't converting into sustained income, Newsmax's model of long-term audience monetization feels like a throwback, but one that actually works. Another thing to keep an eye on is their positioning for political cycles. Media companies tied to news always benefit from election years, but Newsmax more than most. Its audience grows during political peaks, and more engagement means more ad revenue, more subscriptions, and more product sales. With the 2024 election cycle heating up, there's a very real catalyst here for near-term growth across both broadcast and digital. Campaigns will be spending, viewers will be tuning in more frequently, and advertisers will follow the eyeballs. But all of this is not to say the company's risk-free. Being politically aligned brings challenges. It limits how far the brand can expand into mainstream partnerships or appeal to broader advertisers. There's also platform risk. Newsmax, like other politically charged outlets, has had issues with platform distribution in the past. Content moderation policies on social platforms can throttle reach. If major tech platforms decide to tweak algorithms or policies, that could impact traffic or monetization potential. So diversification of distribution through email, apps, and direct access will be critical to maintaining resilience. Then there's the competitive landscape. Newsmax isn't the only network courting the conservative audience. Fox News is still the dominant force, and newer players like the Daily Wire or even digital native personalities are also carving out space. Newsmax will need to continue investing in original content, talent acquisition, and tech infrastructure if it wants to hold or grow its share. So, what does this all mean for investors? Newsmax sits in a rare category. It's not quite a traditional media company, and it's not a startup-style digital disruptor either. It's somewhere in between, with legacy infrastructure and distribution paired with a scrappy, DTC-minded digital business. If they can continue balancing that dual identity, leveraging their broadcast footprint for credibility and audience reach while scaling their digital monetization model, they may carve out a sustainable, highly profitable niche in a media world that's getting harder and harder to survive in. Their recent success in regaining MVPD carriage deals, launching new AI-enhanced content tools, and maintaining growth in subscriptions and e-commerce all point to a company that's very aware of where it sits in the ecosystem and where it wants to go. The question now is how effectively they can execute, especially with an election-fueled wave of viewership on the horizon and a broader media market that remains highly uncertain. So for investors, this is one of those rare companies where traditional and digital media intersect and where audience loyalty actually converts into real, measurable revenue. If they stay the course and continue to adapt, Newsmax could evolve into more than just a broadcaster. It could be one of the more resilient multi-channel media models out there today. Thanks for tuning in, and I am definitely looking forward to our deep dive of what next 5 spectacular number 1 daily stocks will be. New episode will drop every Sundays, so subscribe to get notified when it releases. Until then, check out our podcast playlist to catch up on previous episodes. Thanks.